Two of the hottest companies in the stock market right now announced a stock split this month, Apple and Tesla. Apple's closing on a $2 trillion valuation, and Tesla tripled this year and is up 6 times over the last 12 months. So a lot of people have questions. Should they be buying before the split, after the split? Should they be buying it all? So let's talk about it. Welcome back to the channel. My name is Martin Zeman. So let's talk about these splits. Apple announced a 4-for-1 split and Tesla announced a 5-for-1 split for the month of August. What does that really mean? For each share that you own, you're getting an extra 3 shares in the case of Apple and an extra 4 shares in the case of Tesla. Now, obviously, the share price gets divided by 4 and 5 respectively in the case of these two companies to keep the same market capitalization, right? So nothing changes there. Historically, this used to be so much more common. In fact, we only had 3 companies in 2020 do a stock split, but in the late 90s, if I show you this chart here, you had close to 100 companies in the S&P 500 do a stock split every year. In fact, there used to be funds dedicated to strategies that would trade portfolios, including only companies that were performing these stock splits. Now, why did the companies do this? Historically, companies assumed that there was a sweet spot where they wanted the share price to trade. It used to be around $100. So when the company's share price took off and really traded substantially higher than $100, they would perform a stock split. But these stock splits really faded in prominence after the dot-com bust, and they are much less common in the last 10 years since the global financial crisis. Now, today, 41% of companies in the S&P 500 actually trade above $100. So to have 2 stock splits for such high-profile companies in the same month, for Apple and Tesla, obviously, in a year where we barely see any stock splits, is extremely rare. Now, what does that mean for the actual company and for the stock market and the broader index? When it comes to the company capitalization, nothing really changes, right? The market cap stays the same. You have a different number of shares multiplying by a different share price, you still arrive at the same market capitalization. What changes is the dividend payout. In the case of Apple, on the 13th of August, they paid out a dividend of 82 cents. Now, assuming the next payment is going to be the same, it's going to be divided by 4, around 20 or 21 cents. But the biggest change happens when you come to the calculations of the indices they belong to. Apple belongs to the S&P 500 and is also in the Dow Jones Industrial Average. Now, when it comes to the S&P 500, that index is calculated on a market cap weighted basis. So the market cap stays the same, nothing changes there. But in the case of the Dow Jones Industrial Average, that index is calculated on a price weighted basis. So that means the higher price stocks have more influence on the daily moves of the index. So simply, the higher the share price, the bigger the influence the stock has in that index. At this point, Apple is the highest priced stock in the Dow Jones Industrial Average. It's higher than the 29 remaining companies, right? There's 30 companies in that index. But after the split, they're going to be somewhere in the middle of the pack. And the biggest influencer in that index is going to become United Health Group, which is trading around $300 per share. So what does that really mean? That means that the relative performance of the Dow Jones Industrial Average versus the S&P 500 is going to change. Right now, year to date, the Dow Jones is trailing the S&P by about 8%. And that's going to become worse because Apple obviously has been a leader, part of that group of tech companies, and it's not going to have as much influence in the Dow Jones Industrial Average. So that 8% differential that we have year to date in the first 8 months of the year is only going to worsen. Alright, so this is what happens when you're filming the video outside and a landscaping crew shows up. Obviously a ton of noise, I had to take a break, went for a swim, that's why my swimming shorts are on. But I'm here to finish this little talk on share splitting. So what does all of this leave us, really? If you look at the research dating back to the 50s, it clearly shows that shares tend to perform better in up to 3 years following a split. Institutional investors hate splitting, right? Because for them, it only increases the costs of trading. Suddenly they have to buy more shares for the same dollar value that they used to be able to buy, and it only really generates commissions for the brokerage houses. If you look on the other side of the camp, the godfather of the no splits is obviously Warren Buffett and Berkshire Hathaway. Berkshire Hathaway the Class A share trades at $250,000, right? $250,000 to buy one share of Berkshire Hathaway. He never split. The share is up 3 million% since 1962, when Warren Buffett started buying these shares. It used to be a textile company in the Northeast, and at the time he bought the shares at $7.50. So from $7.50 to $250,000 per share. Clearly his strategy is different, right? Warren Buffett will tell you that he doesn't want investors that will buy his stock because he's splitting. He wants value investors. He wants investors that will buy and hold because they see value in what he's doing. But over time, when you look at the splitting strategy and what company have been doing from the 90s, when this was really common, to post dot-com crash, when this became much less common, and in the last 10 years, post the global financial crisis, there's clearly been a huge change in perception. Previously, executives used to do stock splits because they didn't want their share price appear too expensive. They wanted to attract these everyday investors. But lately, it's become a sign of accomplishment, of the company performing well. If you look at Amazon trades at over $3,000 per share. They haven't done a split in more than 2 decades. So there's clearly been a change there. And in fact, post the global financial crisis, you had the opposite effect, right? You had high-profile companies like Citigroup performing reverse splits. They were in danger of their stock going so low that it might be delisted. So they performed a 1-to-10 reverse split. That's obviously not a great sign for any company. But again, back to our story and Apple and Tesla. The real question is, are you going to be buying these companies because you see them perform a split, because you think that the split is going to generate returns? Or is it the typical catch-22, right? Which one is first? The argument goes that the company simply is producing so much in earnings and is doing so well that the share price keeps running higher and higher, and these splits are only a result of how well the company is doing. And therefore, that's why you invest in the company, right? You're not investing in the company because you see them do a split. So, personally, in fact, I did a deep dive on Tesla a couple of weeks ago. I'm going to put a link up here and the first link below the video where I analyze and go in once Tesla announced the second quarter results. I go specifically in the capacity constraints and the production numbers for Tesla. When it comes to Apple, I personally love the story. My computer is an Apple product. I get an iPhone, earbuds, you name it. But if you look at Apple, in fact, looking at this chart here, you'll see that Apple took 30 years to get to a 1 trillion valuation, and they needed only 2 years, in the last 2 years, to get from 1 trillion to 2 trillion, right? We're closing on that 2 trillion valuation. And I personally obviously love Apple products. I think it's an amazing story. When it comes to the valuation and the reasons to buy Apple, the question really is, when you look at the revenues that Apple generates, 82% of revenues that Apple brings, that product set hasn't changed in 5 years. The last new product that Apple brought to the market was the Apple Watch in 2015. You could argue about earbuds, etc., but really the last bigger-ish product was the Apple Watch. So the question is, and by the way, the bulk of the revenues for Apple is really from a product that's more than a decade old. Obviously, the iPhone has gone through generations of updates, but the power of innovation isn't necessarily there anymore. I'm not arguing that you should be selling Apple or not buying Apple. I'm just saying your reasons to buy a split, your reasons to invest in a stock should go well beyond a split or announced split, and that should really not be the reason. And by the way, the same research that shows that overperformance and a surge in the 3 years following a split, half of that impact happens on the day of the announcement, and that's already behind us. Anyway, so much for the little deep dive on stock splits, how that influences share prices, and what that means for the broader indices and the stock market. When it comes to your decision making, look, I really believe that you should be investing in a company because you believe in the story, you believe in the products, you understand the valuations and what the company stands for. Simply investing in a company, even in a short term, because there is an announcement of a split, that's just not enough reasons for me to invest in a company. Aside from the valuations we discussed and what might obviously happen in the future for those two companies that, like I said, as a consumer, I love very dearly. So There's going to be a lot more analysis coming up. Hit the like button for this video if you enjoyed this conversation. Subscribe to the channel so that you don't miss the future updates on both Apple and Tesla. And I'll see you in the next video.